Welcome back to part three about the Federal Reserve, also known as the Fed. Part three is about what monetary policy is, and maybe a better way to put that is how does the Fed do monetary policy? So we already learned about the Fed, what it is, and then what the jobs are that the Fed has to do. One of the big jobs was monetary policy. Let's talk about that. First of all, monetary policy is anything the Fed does to try to encourage a healthy economy, which means, of course, they're promoting employment, they're trying to control inflation, help the GDP rise, all of that good stuff. And what they do is completely based on either making it easier or harder for banks, businesses, and people like you and me to get access to money, oftentimes through loans. So that's monetary policy. So how do they do it? How do they encourage the economy to be healthy through getting people money or not? Well, three things. The first is the most common one. The most common tool of monetary policy is this thing we call open market operations. Open market operations, put simply, is when the Fed just buys and sells government bonds, government savings bonds. So you remember, you can invest by buying bonds from the U.S. government, and you basically give them money, and you get a bond, and then at a certain date in the future, maybe 8 years, maybe 10 years, maybe less, maybe more, you can come back and get your money back from the government with a little bit of interest, and that's what makes it an investment, a way to make money. So when the Fed does that, there are two things. They can either make an open market sale, which means that they are selling government bonds to banks and to other people, meaning the Fed is going to take the bank's money away. And what that means then is that that bank has less money, and so that bank can provide fewer loans to citizens like you and me. Because instead of cash, now they have government bonds. And no one's going to go into the bank and get a loan in the form of government bonds. It just doesn't happen. So the result is that there will then be less money in our economy. And when there's less money in the economy floating around, that means that people aren't going to buy as much. They're not going to get paid as much. And unfortunately, that means that businesses will probably have to cut workers. So GDP contracts or falls, inflation will fall, and unemployment will rise. Now you might think, well, why would they ever want to do that? Well, they do it just to kind of keep everything organized. Sometimes having an economy that grows too much can actually be a harmful thing. So keeping the reins on the economy through an open market sale is not a bad idea. The other thing they can do with buying and selling government bonds is an open market purchase, and it's just the opposite. They are now purchasing bonds back from banks. So what they do is they basically give the bank cash, and the bank gives them back, the Fed, back those bonds. Now that the banks have more cash money, they are going to loan that money out to citizens, and that will create more money for the economy. This money supply will go up. That means that you and I will have more money in our pockets. Our businesses where we work will have more money to pay us and create new products, and you'll see GDP expand. Inflation will rise as there's more money to spend, and at the same time, unemployment will fall. So it's just sort of the antidote of an open market sale. And collectively, again, those are all overall called an open market operation. Again, that's the most common one, just buying and selling government bonds. Number two, changing the discount rate is another tool of monetary policy. Now, the discount rate is an interest rate. I'm going to get a little bit complicated here, but sometimes banks borrow money from the Fed. Remember? It's one of the Fed's jobs to provide loans to banks when they need it. Well, when they do that, they charge banks interest, and that interest rate is called the discount rate. And so the Fed has control over that rate. And so if they decide to lower the discount rate, it means the banks will probably start to borrow more money from the Fed, because when interest rates are low, people tend to borrow more. So if banks have more money, they will then make their own loans to citizens more often, and that will again result in there being more money in the economy. And you'll see the same results as if there's an open market purchase. You'll have a higher GDP, inflation will rise, and unemployment will decrease. The opposite can happen if the discount rate is raised or is higher. You're going to see banks borrow less because it's now more expensive to borrow money from the Fed. They won't have as much cash, they won't make as many loans, there will be less money in the economy, and things will sort of start to contract and slow down. That's the second job. or a second tool, changing the discount rate. The third tool is that the Fed can change another thing, and this is called the reserve requirement. You might remember a while ago when we talked about banks, banks are required to keep a certain amount of money in their vault at all times. In our class, we've used the example of, you make a $10,000 deposit, the bank has to keep, let's say, 20% of that in their vault, and then they lend out the rest. Well, the Federal Reserve is what decides how much a bank has to keep. So if the Fed wants to, they can force banks to keep either more or less money in reserve. Well, if they keep more, meaning they increase the reserve requirement, that means the banks are going to have to hold back more money, keep it in their vaults. So they'll be able to loan out less, which means that people like you and me won't be able to get as much money from our banks in the form of loans. And again, there'll be less money in the economy and things will sort of start to contract. But if the Fed decides to lower the reserve requirements or drop interest rates, that means the banks don't have to hold back as much money and they can make more loans. That means that you and I will have more money in our pockets, there'll be more money in the economy, and the economy will start to grow. Now, I know all of that is a bit overwhelming, but feel free to rewind and listen again. But collectively, those three tools are monetary policy. Open market operations, discount rates, and reserve requirements keep our economy balanced. And assuming everything goes well and everything works perfectly, the economy should have high employment, low inflation, and strong banks and businesses, which is what we all want, isn't it? So thanks to the Federal Reserve, we should be good to go. If you're interested, there's kind of a fun, cool website you can visit. Right here, you can see this link. I know it's sort of messy, but type this in and see how you would work as the Federal Reserve as trying to make some of these changes. See if you can keep our economy humming along. See what we can do. Thanks a lot, everybody, and thanks for listening to all of this about the Federal Reserve.